Gold has been shooting higher and it's been getting a lot of attention lately. But what about silver? And should I invest in silver or gold? In this video, I'm going to dip back through history to explore the gold-silver relationship, talk about what's changed and where it is today. And by the end, you're going to look at silver completely different and you're going to know exactly where it's going. So stay tuned. All right, welcome back. Happy to have you on the channel. My name is Mark Moss. If you're new to the channel, I like to talk about business, investing, and success. Mostly we talk about investing because, as I always say, it's the most important thing. You have to get your money working harder than you are. If you don't make your money while you sleep, you're going to be working until the day that you die. And with the global markets going completely crazy, right? Stock markets are hitting all-time highs. Interest rates are at record lows. We've seen global debt. It's never been higher. And gold's been at the top of the conversations, like it should be. But today, I'm going to explain where that leaves silver. I've talked about gold a bunch of times, made a few videos about gold. I'll link them up above. And almost all the time, all the comments are, where does that leave silver? What's going on with silver and what's happening with it? And I've tried to answer in some of the comments and I thought, you know what, I'll just make a full video about it. So if you've watched some of the channel, you know I like to go way back through history, right? I go back through history because I believe it gives us a better understanding of where we're going, right? They say that those who don't know history are bound to repeat it. And so I like to go through history, see what happened and figure out where we're going. And so today, we're going back. We're going way, way, way back. In 663 BC, King Ashurbanipal of the Assyrian Empire invaded Egypt and sacked the city of Wasat, which is located in the modern-day Luxor on the Nile River. Now, Ashurbanipal vanquished the city and he seized more than 75 metric tons of silver for his own personal collection. Sounds pretty good, right? At the time, in the ancient world, the prevailing ratio, the ratio at that time between gold and silver was 1:2. So in other words, 75 metric tons of silver was worth 37.5 metric tons of gold. Now that's equal to almost $2 billion in today's money. Now, that gold-silver ratio of 1:2 held up for thousands of years, all throughout Persia, Mesopotamia, ancient Egypt, and probably as far back as we can see, as far back as like 3000 BC. Now, over time, since then, of course, over time it's changed periodically. We've seen that gold-silver ratio change. And by the time Alexander the Great, and that was about 300 BC, the gold-to-silver ratio had shifted from 1:2 to 1:13. Now, part of the reason why is because mining techniques had advanced at that point, and so the ancient people back then were able to produce higher volumes of silver than they were before. It was easier to get, it was easier to find, easier to produce. And under Julius Caesar in ancient Rome, it was 1 ounce of gold was worth 12 ounces of silver, so 1:12. Now, in the time of Muhammad, in the early days of the Islamic Caliphate in the 600s, the ratio was 1:16. So you can start to see it's kind of hovering around there, right? 1:2, 1:13, 15, 1:16. And even in the early history of the United States Mint or I should say under the Mint and Coinage Act of 1792, they established a gold to silver ratio of 1:15. And back then, according to the law, $1 would be defined as 1.604 grams of pure gold or 24.1 grams of pure silver. So those pieces of paper in your wallet or your hand, they're not technically US dollars, but Federal Reserve notes, right? And by the early 1800s, gold started to become a more dominant form of money. And then we went into the classical gold standard in England about 1819. And then it spread to France and Germany and Switzerland and Belgium. And then, of course, to the United States. And as the gold standard started to take off more and more, silver started to become less and less important. Silver had been so valuable for thousands of years, mainly because it carried most of the same essential qualities that great money that gold has, such as being really durable, being private, being default proof, naturally limited supply. It was divisible, it was interchangeable, and of course it was portable. And it's actually the portability that made silver the perfect complement to gold, being useful for smaller denominations and payments, right? And this is the important part, right? Something changed, right? So as the gold standard took off, we saw the rise of central banks, we saw paper gold certificates, And the paper gold certificates, when they were being used, it enabled faster payments, easier settlements to happen on the gold layer. And then what happened is it took away much of the usefulness from silver, right? Silver was used for these microtransactions because gold was big, so silver was more divisible. But once we could put the gold in the bank and just do gold certificates, it took away some of the need for silver. We don't need the easy, divisible, portable silver when we have just paper gold certificates. And so we saw silver's value continue to diminish through the 1800s, and by 1934, President Roosevelt, he set the price of gold to $35 an ounce, and the gold-silver ratio started to climb. Eventually, it reached a ratio of 98 to 1 in 1939, from 1:2, 1:15, all the way to 98 to 1 in 1939. And then, of course, the gold-silver ratio did start sliding back closer to its historical standard. By 1967, it returned all the way back to its 15 to 1 ratio. So if you'd bought it at 98 to 1 and ridden it all the way back to 15 to 1 ratio, you were doing pretty good. The thing was, though, is that level didn't hold up for long, and then the ratio started to climb again. It reached all the way to 100 to 1 in 1991 when silver hit a low of only about $4. So the question you're asking, Mark, that's enough history. I'm tired of history. What does it mean? What does this mean for silver today? That's what we're going to answer. So in order to answer that question, first we just had to understand that gold is pretty unique, right? So there's a fair amount of demand for gold from jewelry. A little bit of gold's used in industrial production, but really the key driver of gold demand is from investors. It's from foreign governments, central banks, and they buy it as insurance. As I've made the video, I'll link to it above. I talked about that. Gold's like insurance. And so when times are tense, when the markets are shaky, people buy gold. And then, of course, the price goes up. I've reported many times, right, over the last year how the central banks are accumulating more gold, or last year the central banks accumulated more gold than any time since 1971, when President Richard Nixon took the U.S. off the world gold standard. But the central banks, they're not buying silver, right? They're not buying silver because silver's different. You see, whereas gold is mainly being bought by investors, not much industrial use, not much jewelry use, silver's different. So silver, 20% of silver demand is from investors, only 20%. And it's usually from smaller retail investors. And they do that because it's so much less expensive than gold. And so we've seen like the most of the foreign central banks, the governments, stuff like that, and they don't even bother with silver. The primary driver of silver demand is jewelry and technology. And that's what I always hear on the comments. But wait, silver is used in industrial applications, and yes, it is. It is used in industrial applications like battery, water purification, semiconductors, dental equipment, and on and on. And that's a very important distinction to understand, right? Silver can't be worth much more than its primary use case. And in a very difficult economy, demand for silver from industry and jewelry, it's likely to decrease, causing silver prices to fall. Gold, on the other hand, right, is waiting for that insurance, right? Gold is waiting for that monetary crisis, a trade dispute, a war to break out, something like that, and that would cause gold prices to go up. That's why gold is insurance. Here's the thing. Don't write off silver just yet. I just want you to understand the reasons why you would buy gold and silver. The reasons why you would buy gold and silver are just different, right? And so, like I've often said, like in the video I did on gold, I made the case that we should buy gold as insurance against a failing economy. And of course, in that video, I had hundreds of comments asking me where silver is, what I think about silver. And so I just wanted you to understand what the differences are of gold and silver. I mean, they're pretty obvious. And really the way I look at it, like I said, gold is insurance. And so what I then look at silver as, it's a speculative bet. And it's a speculative bet. I'm basically betting, I'm guessing that the gold-silver ratio is eventually going to snap back to its more historic standards, closer to the 15 to 1. I made the case where, if you'd bought it at 85 to 1 and got back to 15 to 1, you would have done really well. And so we kind of have that same opportunity today. Right now, today, it's about 85 to 1. It's up from 35 to 1 in 2011, and it's not too far off its historic high of 100 to 1. So the question is, are we ready to see the ratio start to move lower? Are you willing to speculate on that? That's the deal, right? So gold is being bought because it's money, it's value, it's wealth. Central banks are buying it, investors are buying it. But when you buy silver, You just know that silver and gold move together and there's that ratio. And basically what you're doing is you're betting that that ratio is going to get back in line with its historical standards. Now, I tend to not look so much into past history. I like to look more into the current history. And the current history is more of about 40 or 50 to 1. And so that's kind of where we're at. So we're still high above that. But I always want to look at, anything like this, and I want to try to guide my decisions. And so one of the ways that I look at it is obviously history, and we look at the ratios and where it's at. I also like to look at the market sentiment, and I've talked about that a lot, the whole buy when others are fearful, sell when others are greedy type of thing. And as investors, we want to be contrarian. And what that means is when everybody loves something, we want to sell it. And when everybody hates something, we want to buy it, right? Does that make sense? And so I stated earlier that the investor demand isn't the primary driver, but we still want to take a look at it. So we still want to look at investor sentiment, even though it's not the primary driver. And when we do look at it, we notice that investor demand is currently low. And so according to data from the US Mint, the average number of 1 ounce silver eagle coins sold over the last 3 years is half as much as the average sales from the previous years, or I should say the previous 8 years. So it's way off. Investor demand's way off. And so the bottom line is that investors aren't as interested in silver as they used to be. And that's usually a good time to start thinking about buying an asset, being the contrarian. Another key factor that I like to look at is that silver production is falling. And of course, I said we use it for manufacturing, and so we need it. And so anytime an asset that's needed has a genuine need and the production is going down, well, you can guess what happens. As I mentioned earlier, we don't really see that production need in gold. And so all the gold that's mined usually ends up in a vault somewhere. Maybe it ends up in someone's jewelry drawer. So as mining companies pull more and more gold out of the ground each year, the supply increases. But silver's different. Most of the silver that's mined this year is going to end up used. It's going to be used in industrial production so that companies make so the companies that make the fancy tableware or the dentist drills, right? They need new supplies, and they're going to need more silver next year in order to manufacture the products. And so the companies that are growing as electronic scale, things like that, they're going to need even more silver. So as long as the global economy just keeps growing, I believe we'll see industrial silver demand continue to grow. But silver production is actually falling. So silver prices should increase as a result, just basic supply and demand. So what you do is you take that and then add to the fact that gold's been shooting higher this year, right? We've seen gold shooting higher. We have the central banks that are buying more gold than any time in history. All the central banks around the world are just printing money simultaneously, and gold prices should continue to increase, and hopefully as they increase, they're going to drag silver right along with it. So to recap all of this, gold's the safer play, right? Gold's the safer play with massive investor demand, central bank demand, and silver is more explosive, and it could shoot much higher, much faster, but it could also continue to fall with more risk, right? As they say, with more risk comes more reward, hopefully. And so what you want to do is you want to manage your position sizes accordingly. That's how we manage our risk. And so you look at the risk to reward ratios, and then you manage that through your position sizes so you can take advantage of it. I think that silver, I think it's a good time to buy silver. I think it's going to try to keep up with gold, with the price of gold. We just have to worry about that ratio. It's at a historic high level. Hopefully it could return back to the 50 level. It could be good, but you have to understand my point. Hopefully I've made my point. The reasons why you buy gold and the reasons why you buy silver are just different. And so you need to understand that so you can make a good decision in your own portfolio. Does that make sense? If you like the video, give me some thumbs up on the video. If you're not subscribed, click the subscribe button down below. Make sure you hit the ring the bell so you know every time I put out a new video. And that's it. Hopefully you like that video. To your success, I'm out.